better.
I know, mate, I know.
Yeah.
More to come.
Thank you very much. Great to be here. So we've got about 30 minutes to talk about a very important subject, ETFs. I think if we're thinking about sort of mass adoption for crypto, which I think everyone wants, ETFs have been and will continue to be sort of a key product enabler for that. So I think let's spend a couple of minutes sort of level setting. We've got a great panel here with me today. We've got two world-class ETF issuers, so Mandy from 21 Shares, we've got Dovile from Wisdom Tree. I run a company called Twinstake, which is a staking provider. And then you have Matt here, who runs a company called Trufin, which is a liquid staking provider. So we sit on the kind of yield gen side of it, and then you have the issuers with us today. So let's just sort of jump straight in, right? And I guess first question to the issuers is, like, what is an ETF? Let's start with that. And how does it differ for a retail investor to just buying the asset outright? Let's go to Dovile for this one.
Hi, hope you can hear me well. So ETF is a wrapper that most investors are comfortable with. So by buying, let's say, Bitcoin ETF or ETP, exchange-traded product, you're able to have the institutional model where asset is held securely in cold storage accounts. And if you go directly into the asset without the exchange-traded product wrapper, then you need to make sure that you're not getting hacked. You need to manage your passcodes, wallets, etc. So ETP, or exchange-traded product wrapper, simplifies access.
I don't know what I can add after that. So ETFs and ETPs, basically you trade crypto just like you're trading Apple stocks. And I think let's separate institutions and retail here. But for institutions, because ETFs are such a highly regulated product, because it's regulated by a regulator and also the exchanges, it's extremely attractive to those institutional investors. And then on the operational side, the feature that it can trade just like Apple stocks is actually really critical. You might think institutional investors have all means in the world to access crypto. They can open a wallet if they like, but in reality, they prefer to focus on what they're really good at, which is adding value to their portfolio rather than having to deal with the wallet and some of the details. That doesn't cover all the institutions. Some of them are more sophisticated, of course. And obviously, I'm biased, right? But I guess by no means am I saying you can only buy ETFs and nothing else. I think that even different ways have their pros and cons. But I think that the fact that you don't need to worry about losing your private keys or getting margin calls when you're sleeping, that's definitely one very attractive feature for a lot of investors when they take their first step in crypto.
So who are the investors on your products? Is it a mix? Is there any retail investors in there, or is it just institutional allocators?
It's absolutely a mix. And actually, the past few weeks have been very, very exciting here in UK, because finally UK retail are able to invest into Bitcoin and Ethereum exchange-traded products that are listed on London Stock Exchange. So it's a very exciting development, but UK is way behind other European countries that have had these products accessible by both retail and institutional for the past few years.
So what we observe both in Europe and the US is you have this barbell allocation of investors, which is you have a set of institutional investors who are really advanced. They already got into crypto space. And majority of investors are actually retail, self-directed retail. And when I say majority, it really is a huge skew compared to a typical ETF. So what is very obvious here is who are the intermediaries? Where are they? Right? You don't see them that much in that allocation. And it's both in the US and Europe. And in Europe, there are reasons because the users have not opened up to crypto. In the US, I think they are still slowly adopting to that. They are most of the financial advisors, they're okay to take the trades when the investors place the trades, but they are just still not brave enough to advise crypto yet. So I think there's still quite a long way to go. And that obviously manifests itself in the flows and the investor behaviors and how we design products, of course.
You mentioned about the ruling in the UK. Do you think that's going to be sort of a key driver for pickup of demand in the region?
Absolutely, yes. So UK retail investors, they want access to crypto. They have been investing directly, but now they are able to have Bitcoin and Ethereum exposures within their ISAs. And me, as UK retail, I'm very, very excited about that. Because having tax-free investment in crypto is all that I could have ever wanted. So thank you, UK.
Yeah, so I would say after 4 years, crypto ETP ban is good news that it's finally lifted. But you probably noticed the day was the 8th of October, what everyone was talking about. But for 2 weeks, it was really quiet because no ETPs was actually approved until this Monday. So, you know, congrats to the both of us. I'm probably less optimistic than you at the moment. I feel like this is just a starting point because we're still playing with the puzzles with a lot of missing pieces. The ISA account is still very unclear. We had some major UK brokers still say, well, actually, I don't recommend my investors to buy crypto. So I think there's still a lot of battle ahead, in my opinion. So if anyone has any UK brokerage account, call your broker, ask them why those ETPs are not onboarded. I want to invest in it. Give me the appropriateness test. I know everything about crypto. Let me invest in it. The harder you push, the more likely those platforms will actually open up because it's not good enough they are traded on exchange if the brokers don't give you access to it.
Makes sense. I think that's been one of the key drivers of US growth as well, is sort of the distribution and access. You can just invest in some of these funds straight into your sort of retirement accounts. I think that's a kind of massive thing. Just on I saw the headline from the UK and it said ETNs. So just spend 30 seconds demystifying ETFs, ETPs, ETNs. We all the same?
My favorite question. So I always say ETP is an umbrella term which covers ETFs, ETCs, exchange-traded commodities, and ETNs, exchange-traded notes. Different European countries use different wording. So some countries call crypto products ETCs, exchange-traded commodities. Others call exchange-traded notes or ETNs. So we, as issuer, we use umbrella term. But for investor, nothing changes. Because if a product is physically backed, in Europe that means 100% physically backed. Because these products receive crypto assets in kind from authorized participant or gives crypto assets out to authorized participant who then sells in the crypto market. So the product itself only ever holds direct crypto exposure. And in Europe, we will never use the phrase ETF or exchange-traded fund for crypto because ETFs are subject to UCITS rules and UCITS have concentration limits. And if a product is Ethereum, so it's 100% exposure to Ethereum. There is nothing else, so it's not diversified.
Yeah, I think the key word is ENT, and the rest is not that important. So exchange traded. They could be fund, they could be notes or debts. And like Dovile just said, they're pretty much doing the same thing. They give you that investment exposure just by different structure. But what's important is you have that equivalent crypto to back that claim of that return. I think that's the most important thing. Forgetting about the terms, right? I love those terms because, you know, I'm a product person. This is my favorite, but I won't take you down the rabbit hole. But if you are thinking about, should I invest in ETF or ETP? What is going on? What is this ET something? What do that actually mean? I would say go through the process of, first of all, is that a fund? And if that's a fund, is that, if it's in US, you ask, is it a 33 Act or 40 Act? And if it's Europe, you ask if it's a UCITS fund. And if it's a debt instrument, you ask if that's fully collateralized. That's really important because FTX happened because your exposures are not collateralized. And that's a critical feature. And then if they say it's collateralized, ask them where's the proof? Where's the offering document? Where is the audit report? And that's how you do, that's my sort of 2 cents on how you do your due diligence. And whether it's not ETN, ETP, ETC, for me is less relevant.
Got it. You mentioned a few sort of technical and structured phrases there. So you've got UCITS in Europe, you've got the 40 Act and the 33 Act in the US. If we think about the structure per region and the landscape of the ETF world within the US and Europe, do you have any sort of comments on that? As in, you know,
so
what are Europe's strengths versus the US? What are the US strengths versus Europe?
Yeah, so, well, US strengths very clearly, they have a massive amount of money. So you're looking at, Bitcoin only, if you compare Bitcoin ETF in the US to Bitcoin ETPs in Europe, we're looking at 20 times the AUM. right? So, and Ethereum is about 12 times. And we do believe it will reach 20 times very soon once the staking starts. But I think in the US, the strength is that they just have a massive amount of capital to invest. Europe, for crypto, we did take advantage that we opened up the market much sooner than the US. So in Europe, for years, we have very clear guidelines from the exchange, what kind of tokens can be approved for ETPs, what kind of basket can be approved. It's all rule-based, it's very clear dialogue. In the US, you just had a generic listing rule 1 month ago, and then the government is shut. And UK, exactly, is far behind. At the moment, they just allow for Bitcoin, Ethereum. Fortunately, staking is okay. But next battle is, what are the other tokens? And what are the rules, right? This can't always be a positive list of tokens. It needs to be more rule-based to facilitate the market demand.
Dovile, any comments on that? Because Europe was first, right? Europe's a little bit more innovative in many ways, but the US has somewhat, engulfed Europe.
I always use the phrase, I'm a proud European, because I think that the structure that Europe has is so much better, and US is only now catching up. And what I mean is, in Europe, we have been first with having these products. We are still first with respect to having in-kind creations and redemptions. In the US, it's cash that is going into the product, and then the product has to trade that cash for crypto, or trade crypto out into cash to be able to accommodate redemptions. In Europe, it's authorized participants who are taking the risk of trading in crypto markets, of getting hacked while crypto is being delivered into the cold storage wallet as the custodian. So here products only ever have 100% exposure to the crypto that they are supposed to have exposure to, and never hold cash, never need to have hot wallets that can be hacked, and never have any slippage related to trading cryptocurrencies. And in the US, they are only now catching up. And when I say now catching up, US government is on break, as most of you may know. So once they come back, Securities and Exchange Commission has said that in-kind creations and redemptions will now be allowed in addition to cash creations and redemptions, but the market is still not there.
Yeah. I think distribution is such a key thing for the US as well. Like being able to access crypto and ETF funds through your brokerage account is such a big thing. I think the US, the fact that you can just go in, allocate a certain fund to your retirement is a huge win.
And actually, just on that, so US are now talking about opening 401k accounts to crypto.
Exactly.
And if that happens, then it's incredible development, because 401ks accounts have trillions of dollars in savings. So there, if investors are able to allocate to crypto, that will be strong demand.
I guess I'll add to that. It's more on European side. Crypto is still not eligible for UCITS funds. And just to give everyone an idea how big that market is, it's 13 trillion AUM in US dollar. And if any, I'm not talking about all the funds investing in crypto, but if on average a half-bit investment is already hundreds of billions. And at the moment, those money are rejected out of the door. And those funds, they are professional investors. Again, the intermediaries that I just talked about, the professional sort of in the spectrum, they are still completely rejected outside of crypto.
All right, Matt, you've been sat there patiently. Let's bring you in. Let's talk about staking. I'll have a conversation with you. So you've got Bitcoin and stable coins, and everything else is some sort of, I guess, proof of stake or proof of stake-like consensus mechanism, which then brings in staking. A key feature of the main tokens, Ethereum, Solana, you can get about 3% yield on Ethereum, about 7% on Solana. So because these assets are yield-bearing by nature, you would want to make sure that they're integrated into products that we've been talking about. So how do you sort of see staking on ETFs? Simply, can an ETF stake? Can it stake 100%? Can it utilize your product?
Yeah, I think a lot of the issues at the moment with some of the ETFs, especially in the US, the ETH ETFs, don't currently have staking enabled, mainly because of almost the liquidity mismatch that would be in place. So a key feature, I think Mandy mentioned, was the redemptions that you have, or the daily trading that you have of the ETF products. The problem would come if you staked 100 of, let's say, the ETH ETF, the exit queue or the unstaking period that would need to be undertaken is kind of variable. It can be kind of quite lengthy at times.
It's nearly 40 days.
At the moment, so 40 days. So it's managing that liquidity mismatch, which is an issue, which is, I think, the main reason why, especially in the US, staking hasn't been enabled or allowed for those products. We have seen some, obviously, in Europe where you do have staking-enabled ETFs, but there's just a much, much smaller proportion of the ETF which is actually staked, and so they're kind of leaving yield or kind of essentially kind of returns to investors on the table.
So can I just add to that? So 21 Shares just started staking in the US. It's not long ago. I know the government was
Gone,
shut,
have you?
but
The government's
we just
shut
started
and you just go.
asking for forgiveness
Straight through.
afterwards.
Yeah, we've seen a few go in the US, so that's been the talking point for the last year. Is that's a key differentiator between ETH and Bitcoin. We've seen a huge growth of specifically IBIT, I guess, in the US, and spot ETF was permissible, but not staking, and that's a key difference between ETH and Bitcoin. So it's a yield-bearing asset. You want to get that yield, but the SEC obviously had their issues. The IRS had their issues as well. How do you treat the staking rewards? You have a particular structure in the US, which is it's a grantor trust structure. It's a very passive instrument. You can't really touch it. You can't show active management. So it throws up some sort of questions. So they've been working their way through. And I think we got to a good point. Then the government shut down, and then everyone just went anyway. So we saw Grayscale that went. They've now gone up to 60% of their ETF is staked. And I think we're likely to see those sorts of numbers. About half of the underlying AUM will be staked where it can be. And that can be a differentiator between some of the product types. So 21 Shares have gone as well, have they? Asked for forgiveness post government opening. So for ETFs themselves, it tends to be kind of core staking at the moment. Do you Trufin is a liquid staking protocol.
Yep.
Do you see that being enabled at some point from a regulatory perspective? Do you see it?
Yeah, I think so. I mean, the SEC recently came out with a statement being pretty favorable with the view around liquid staking and liquid staking receipt tokens and whether they be permissible within ETFs. At the moment, it's still not law. It's very much a statement on that part. But there was, I believe, the Rex Solana ETF in the US actually does have a certain portion of the holdings in
Twinstake did the staking on that as well.
Right? So a very small proportion at the moment, but I think it could be a lot higher. There's no real reason, once kind of the regulatory piece gets kind of worked out, as to why liquid stake tokens couldn't be a very effective mechanism and tool to help meet that redemption process and liquidity mismatch that is in place. But there's obviously a few things that need to be put in place before that's the case.
Because liquidity is such an important thing. Obviously, we talk about the mismatch, and just to be clear, ETF issuers have redemptions to meet. If their end customer withdraws the funds, they have to meet those redemptions within T+1 or T+2. If you stake the assets, you can't get them back within that period. So you have that mismatch, which is why they're only staking about half in case they see these redemptions coming through. So now thinking about how do we get liquidity on it, and I've been discussing many different solutions with all the large asset managers, and you kind of fall back on things like, okay, well, we need dollar lending essentially. That's the only really permissible thing you can do unless you have, say, a capital markets desk of your own, because they're not that comfortable with the solutions that crypto is putting forward at the moment. Even though things like liquid staking are the risks are well known and have been got a credible track record now, still take a little while to kind of see that come through.
Yeah, and I think you saw actually yesterday it was VanEck which actually put out a Lido staked ETH ETF proposition. So I think 100% of the assets were proposed to be kind of liquid staked for that fund. We've done something similar at Trufin, but in a kind of Cayman non-ETF style wrapper, just to show that it can be done. And you have that fund which is staking 100% of the assets, providing pretty much the full staking rewards to clients. And I do think that's the position where some of these ETFs will go to. You'll probably have 2/3 to 3/4 natively staked, depending on the typical redemption rate that you see for those products. And then the remaining portion will be made up by liquid staking. And then you'll say essentially having still 100% of the fund staked, but just in a slightly different proposition between native staking and liquid staking making up the remaining portion.
So if you're invested in an ETF, what will be the sort of, I guess, estimate in uptick in yield? So let's just say it's an ETH ETF, you stake half, which is going to be about a 1.5% yield. You have a portion which you can liquid stake. What kind of typical uplift do you think you'd see in terms of?
Well, I think it just depends on what proportion of the fund is currently not staked. And so, if they're only staking 50% of the returns at the moment, you kind of add liquid staking into the mix and stake the remaining 50%, then you're doubling the yield that you're getting on that actual fund, which is significant when you factor in some of the fees and other costs that go into some of these vehicles. The return to the investors is much, much better. And for certain chains and assets like Solana, where the staking reward rate at the moment is approximately 7.5%, 8%, depending on kind of the day of the week and network activity. If you're not staking those assets and you're just sitting in the native spot, you're getting inflated away at 7.5%, 8% per year, which compounded over a couple of years, it kind of starts to really add up.
So we talked about entry points for retail investors to come in. They can, do it themselves and buy the underlying asset. They now have access in the UK to ETNs. We've seen the sort of emergence of a new entry point through digital asset treasuries. It's not really here in the UK, but it's predominantly in the US, where I guess MicroStrategy were the first to do it. Now you've seen multiple assets come to market, predominantly listed on NASDAQ, buy up a shell company, and now suddenly you're a Solana shop or an ETH shop. You're going to buy the asset, stake the asset, buy more of the asset, stake the asset. So how do you see this as a threat to your sort of world?
Yeah, so ETF started as a disruptor to the fund industry, right? So it's only a matter of time when someone comes to disrupt us. So I think in my view, I think the market is big enough for more than one type of product. And I think eventually it's about the quality of what it's offering. There's no reason why the market couldn't have DATs and ETFs both in existence. I'm obviously biased because I think ETF is a great instrument. I've been working on this for more than 15 years. I think it's just transparent, it's predictable. It tracks an index or tracks the price of the assets, and that's what it does. And the tracking is typically extremely tight. So for me, I think a predictable outcome is very important. But of course, I think for some investors, you can rely on the skill of the experts. Right? It's very attractive to a lot, like Michael Saylor, for example. It's very attractive to a lot of investors. So it's just the result is less predictable. There's a delta, a leverage around that. It's less predictable. But I think in some markets, where in the UK before Monday, for example, that could be a very good way to get access to crypto, because you just can't buy crypto ETPs,
yes,
right?
I was about to say they were allowing you to buy a kind of leveraged Bitcoin DAT through strategy in your pension or your ISA, and then they weren't allowing you to buy a Bitcoin ETF, which is just kind of crazy. But
yeah, and you can buy 3 times leveraged ETPs on equities, but you can't buy crypto. So there's still a lot of engagement with them. But for me, I think it's a healthy competition, and what's most important is the quality. And I would say for investors, it's important to know what you're investing in, who you're investing with, and how you invest in it. So if you like leverage, I think that gives you more of that exposure. But if you want predictable outcome, it's ETFs. Who you invest in is also very important. Who takes your money and make use of it. You should really look at the offering document and see if that's something you believe in, and look at the background of the people who are involved, right? Or the company, the ETF provider. Do you trust this brand? Do you trust these people to run your money? And the third is how you invest in it, because maybe another strategy is more, you prefer another strategy, but then you have, you can access another less favorable instrument in your tax-free account, in which case you might want to think about which one is more effective. So there's no difference between this and just a typical investment. I don't know, Dovile?
I echo everything that you're saying, and also would say that for most investors, especially retail investors, it's important to avoid panic buying or panic selling. And it's very important to have proper plan around why you're allocating to this specific exposure, how it fits into your overall portfolio, and how frequently you want to rebalance. So just have a plan and execute it. And it's much easier for majority of the investors to invest into crypto that is 100% physically backed by specific crypto exposure that you want, rather than going via leverage or indirect exposure, such as that.
Mandy, I'm going to press you on what you just said there, and you talked about the quality. Does that infer, or can I infer that you think there's too many on the market? Too many DATs? Are there too many DATs that are listed in the US? Not enough high quality ones? Is that what you were trying to say?
So I was at another crypto event, I wouldn't name it, last week. And that was the same question everywhere. And again, there are 11 Bitcoin ETFs in the US, right? Are there too many? I mean, each of them is still offering different sort of offering products to different audience because investors maybe trust one brand more than the other. And I remember
in the digital asset treasury space, I mean. In the digital asset treasury space, we see more and more DATs being listed.
There's more and more, yes.
Multiple ETH ones, multiple Solana ones. Do you think there's too many?
No, I think the same apply to DATs. Because if you can have 11 ETFs doing the same thing, why can't you have more? Eventually, they just need to prove how they differentiate. Because there's so many types of DATs. Some of them are more pure play. Some of them are a bit sort of, adding a bit of a return to their existing business. And some of them are more like a basket of different types of cryptos. So I think it's still important to go back to their offering document to really look at what they want to deliver. And do you believe in what they want to deliver? And do they deliver what they promised? So on that basis, I think it's about differentiation. And eventually, at some point, some of them will probably consolidate. But I think we're still in a very early stage right now.
Yeah, you've seen a lot of compression though in the MNAVs of these, or like the multiple compared to the net asset value that they're trading at across the DATs, and it's only really a kind of very small select handful of which are actually trading at kind of a premium to the net asset value now. You had MetaPlanet, which was at like an MNAV of 7, it's now below 1. MicroStrategy still got a premium, but there's very, very few DATs which are actually having that premium. So I think they've compressed pretty darn quickly. And I expect to see some consolidation just in terms of acquiring larger DATs, acquiring smaller ones, which have got a lot of toxic debt and not really able to fulfill the promises on that side.
I think so too. I see the two worlds as sort of the equivalent of passive versus active management. I think what's going to be interesting on the digital asset treasury side is ETFs sit within a particular structure. As you mentioned, it's physically backed and it tracks the underlying very nicely. Whereas in the digital asset treasury space, you then have the ability for somewhat active management. I think that's a really opportunity if I think about something like yourself, Matt, at Trufin, it doesn't have the same regulatory wrapper. And so what you're going to see from the digital asset treasury companies is they'll stake a portion. And if they stake 50%, suddenly their return is similar to that of a listed ETF. And then they've got some sort of leeway in which they can do additional sort of yield generation type activities.
Yep.
And in that way they can differentiate from each other.
Yeah, I think we've seen, especially on the DAT side for some of the Solana DATs and some of the Ethereum ones as well, there are a few DATs which have been much more vocal about what they're going to be doing on chain to generate an additional yield. A lot of it comes down to kind of what is the actual yield they're able to get on the underlying asset they're looking to acquire. Staking, you'll get the market rate of return in terms of everyone can participate. But for those that are slightly more sophisticated on the asset management side, we've seen some that are wanting to do more DeFi native activities on chain where they'll use the LST and then look to generate additional yield through other opportunities, whether that's lending, liquidity provision, things like that. And also on the slightly more esoteric side and slightly kind of further out the risk curve, even those that are looking to kind of pursue different option structures as well. So covered calls or simple strategies where they can really increase the yield on the underlying assets and be more capital efficient. And those that are successful in generating a higher rate of return and a higher yield on their underlying assets over a period of time, you expect to see outperform over the long term, but it's still pretty early days on that side.
Yeah, and I agree with you. It feels like an active fund, right? Or active ETF almost. But I would say less than like an ETF because ETF is open-ended. It feels more like a closed-ended fund. So again, nothing new under the sun. They're just different structure, but they're doing just what closed-ended funds are doing. And they add value in their own way, just very different objectives from ETFs.
Yeah, I hope it becomes complementary and another access point for retail or anyone that wants to get into crypto. We could talk all day. Last question though, just how do you see, I guess, the future, the rest of this year, 2026, within your particular world? Dovile, do you want to start?
I see more and more investors making long-term crypto allocations, and I see more and more investors going outside just having only Bitcoin within their portfolios. People have been investing just in Bitcoin exchange-traded products for over the past 5+ years, and now they're looking what's outside there. So they are looking at individual altcoins such as Ethereum, Solana, Cardano, Polkadot, etc. But they're also looking for crypto baskets, and especially crypto baskets that do participate in staking. So I see more adoption of that over the coming 12 to 18 months.
You stole my line about basket. Like we said earlier, at the moment you have retail self-directed. They like to buy single tokens, which is what we are really good at the moment. Institutions, they mostly just buy Bitcoin, Ethereum. That's why you see basket ETPs really underperforming in terms of AUM, not in terms of return, but in terms of AUM. We do think it's going to change when the intermediaries start to come in and institutions get more comfortable beyond Bitcoin, Ethereum. They want to have top 5, top 10, don't want to pick the basket, the tokens. They wanted something naturally rebalanced. And I think that's opportunity for crypto for sure. And also I would say staking is really critical to the next round of growth. Like I said, Ethereum ETF are still underperforming in terms of AUM gathering compared to Bitcoin. And a larger part of that is because a lot of money are still sort of going towards Europe and other instruments because those US ETFs can't stake. And hopefully, once we get through this 40-day cycle, I think more people, the ETFs will stake more, and investors will start to see the benefit, and US government reopen will hopefully enable more ETFs to stake, more investors get comfortable, and then that's when the next round of growth will be.
Yeah, I think on the liquid staking side, it's been something which has been very much driven by retail, like a lot of DeFi native and on-chain primitives typically are, but we're starting to see kind of the grassroots of institutional adoption on that side, both from DATs and also some of the conversations around the ETF issuers, potentially including LSTs in the amount of staked assets they have. So I think we'll see quite meaningful growth on that side, but it's obviously dependent on regulatory environment, a few other things which are a little bit outside of our control as well.
Fantastic. Thank you very much, panel.
Thank you.
Thank you.